Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillah. Hello everyone. Good to see you. And today I'm going to review the topic that we discussed in the class, which was about the balance of payment and exchange rates. I'm just going to make a quick review about what we have discussed in the class and what we left uh, in the last class, and hopefully this video can help you in studying and in preparing the final exam. Right. So in this topic, we learn about the exchange rate, and we know that exchange rate is one of the important aspects for the business players, usually those who conduct trade or international trade between countries. So the most important aspect that need to be considered is the exchange rate. So they will look for a favorable exchange rate, and they will try to monitor every fluctuation in exchange rate. And once the exchange rate is favorable, they will conduct the international trade. In the last class, we have also introduced you the balance of payment. We remember that one of the difference between open and closed economy is that the closed economy, they don't have next export. They don't have international trade between the country to others. While in open economy, they have international interactions in terms of trading. So they do export and imports. They exchange goods, services between countries. And this make up their balance of payment. So what is balance of payment? It is the record of a country's transactions in goods, in services, in asset with the rest of the world. It is also the record of the country's sources and uses of foreign exchange. So we can track down the economic activity between the country to others, between such country to others, by analyzing their balance of payment. Right. So in the balance of payment, there are two important components of balance of payment. The first component is the current account, and the second component is the capital account. The current account, usually they records the exchange of goods and services, while the capital account, it usually records the movement of capital between countries, between the local residents or the local investors to abroad, to the foreign countries. This was so this is the looks. These are the data of the balance of payment for the United States in 2009. So as you can see here, there are two big components: the current account and the capital account. The current account usually they records export and imports of goods and services, while the capital account, it records the movement of capital between one country to others. And of course, in every country, they have their components of current account and current account and capital account. So you may find some differences between the balance payment of the United States and the balance payment of other countries. So each country has their own style, their own standard, their own measurement of balance of payment. But I believe that the two important aspects that become the standard are the current account when they record the trade of goods and services, and the capital account where they record the movement of capital between one country to others, right? Okay. Next we discuss also about, there's a hypothesis, in the economy, which says that when income rises, when we have an increase in salary, our imports tends to go up, tends to increase. This happened because when we have an increase in our salary, increase in our income, we usually consume more. We tend to consume more. We tend to buy more product and services. And these products and these services may come from abroad, or they are imported goods and services. So it has this kind of a positive relationship. When we have an increase in income, our import usually goes up, because where we have an increase in income, where our salary increases, we tend to buy more product, we tend to consume more product and services, and these product and services come from imported. They are imported, and they come from foreign or multinational companies abroad. So they write a simple mathematic function here, where import is a positive function of income. So wherever we have an increase in income, our import will also goes up. Then we have the marginal propensity to import. This is the change in import that are caused by a $1 a change in income. So we can, later on we try to calculate this change and this simulation. So it says that we can measure how much increase in import for every dollar increase in income by measuring the marginal propensity to import. And then we have this model, where the red line is the planned expenditure, that was made up from consumption plus investment plus government spending plus export, while the blue line, it is the summation of investment plus government spending plus export. So the difference between these two lines are consumptions. So they try to to show us how the planned aggregate expenditure are derived when we have every components C plus I plus T plus export. And in the second model here, we have a change in our planned aggregate expenditure when we have a change in wait a second. Oh yeah, okay. So the red line above here, it is the planned aggregate expenditure that was only made up from consumption plus investment plus government plus export, while the red line below is a planned domestic aggregate expenditure, when they have a consumption plus investment plus government spending plus export minus import. So you see here the difference between the two lines are the import. Okay, so this is like the model to show you the differences if we calculate our planned aggregate expenditure by considering import or by not considering the import. All right, so we have here the open economy multiplier. Yeah, so we can know the effect of an increase in government spending, or an increase in investment, uh, on the national income. And it says here that this multiplier, the effect of this multiplier is smaller in an open economy than in a closed economy. And the reason why we have a smaller effect on our multiplier for the open economy is because when the government spending or when our investment increases, the national income will increase, so that our consumption will also increase. And some of this extra consumption spending that results in foreign product and not on domestically produced goods and services. So imagine if you're living in a closed economy, when your government increases spending, or when we have an increase on our investment, we will have an increase in our national income, right? On why? And this will lead to an increase in our consumption later on. Because as the countries goes richer, they have more money, they will consume more, so our consumption will goes up. But what happened if we have an economy with an open style, the open types of economy, some of this consumption will be used for consuming or for buying imported goods and services. And so some of our consumption will be on imported goods and services. So when we have imported goods and services, who will take the benefit? Not the local economy, not the local industries, but this benefit will go to the foreign companies who exported their product to our country. So that's why the multiplier effect will be lower compared to the closed economy, when they don't have an international trading between themselves and other countries. So in the closed economy, all the products that are sold in the market, that are available in the market, are coming from the local industry, the local businesses. So that's why when we have an increase in income, our consumption will also increase, and this consumption will be used to buy more local goods and services, not from imported goods and services. That's why we need to check this, to check this balance. Usually the policymaker will think that they should have a right policy to balance, so that the local industry are not destroyed by the many imported goods and services that are selling in the market. Because they don't want, the foreign companies and the foreign multinational company to take the most benefit. That's why they have to balance between the development of local industry, the growth of local industry. At the same time, they allow foreign companies to sell their product in our local market. Okay, so next we have the determinants of imports and export. During the class we discussed that one of the important determinants of imports and exports are the relative price, the relative price of our domestically produced product, yeah, versus the foreign produced product. Yeah. So usually when we have a product that can be sold at a lower price compared, yeah, to, compared to those products produced in foreign countries, yeah, we will have more export because everybody, yeah, will consider our product because they are selling at a lower price compared to the global competitors there in the market. So our export will rise, our export will increase. But if we see that our local produced product, our local products, yeah, are more expensive compared to those products that are available in the global market, what will happen? Yeah, of course, we will buy from foreign markets. We will buy from foreign companies because here at the local market, those product and the same product that locally produced, they are selling at higher price. They are more expensive. So that the local residents in the country will buy abroad, yeah, will buy from the foreign companies. Yeah. Another important determinants of, for example, for export is that we need to have a good economic situation. We need to have a growth, yeah, in economic. If we can maintain a good economic situation, we can maintain economic growth, yeah, the global economic growth, so that those foreign buyers can have an income, can have a rise in salary. Of course, they will increase our export because they will tend to, buy our products, yeah, because they have more salary, more consumption. So that they're buying our product. Yeah. So the relative price of our goods compared to others and the economic situations, the global economic situations is also a determining factor of exports. Yeah. So we need to have a good consideration of this aspect. All right. This is where we stop in our last class. So I think that I will discuss, yeah, this slide, yeah, in more detail now. Okay. So next we have the trade feedback effect. So what is the trade feedback effect? It is the tendency for an increase in the economic activity of one country to lead to a worldwide increase in economic activity, which then feeds back to that country. Yeah. So an increase in the US imports increases other countries' exports, which stimulates those countries' economy and increases their imports, which increases US exports, which stimulate the US economy and increase its import, and so on. So this feedback, this trade feedback is called trade feedback effect. Yeah. So here it says that the economy is a kind of a cyclical action. So when there is an increase in import, yeah, in our country, this import will benefit foreign companies, It will make their economic grow. It will make their economic prosper. So once they achieve economic growth, they have more money, they have more salary, they will increase their import too. They will buy more products that are produced by our country. So this effect is called the trade feedback effect. Yeah. So in other words, yeah, if we have a good economic growth, if we have a good economic situation, this will also, push other economies to grow and push other economy to have an economic expansion. Yeah, because when we grow, we tend to buy more of their product. It push their economy up, and it makes them grow, makes the economy prosper. And once they become prosper, they will also buy back our product and etc. So there's kind of a cyclical action of trade between this country to others. All right. Wherever, and also whenever we have a recession, for example, yeah, whenever we have a recession, this recession will also lead to economic decrease for other countries, because once we have a recession, we will not be able to buy the products, imported products. Yeah, we will just focus on surviving, focus on, like, to survive and buying the needs that are very important to us. Yeah, we usually during the recession we don't care about buying luxury goods and etc. So that's, I believe that during the recession our import will also decrease, and this decrease in import will give effect to other countries. Yeah, so because they're having less exports, no benefit coming to their countries. Yeah, and this will make their economy also have a recession. That's why we have this kind of uh, spillover effect. When one country they have growth, this growth usually push other economies, yeah, surrounding them to have also growth. But when we have an economic decline, economic recession, and crisis, this may also, this may also push the other economies that are surrounded in that are in their surroundings, yeah, to have an economic decline and crisis. All right. Import and export prices and the price feedback effect. So export prices of other countries affect US import prices. A country's export price tend to move fairly closely with the general price level in that country. That general rate of inflation abroad is likely to affect US import price. If the inflation rate abroad is high, US import price are likely to rise. Yeah. So this is also another, another hypothesis in the economy, which says that, yeah, when we have an increase in our export prices, yeah, so when we have an inflation, yeah, in abroad, which make the import prices increase. Yeah, for example, we're doing a trade with Thailand, yes, and we are importing from Thailand rice. Let's say that Thailand is experiencing inflation, which make the imported products coming from Thailand raise in price, yeah, become more expensive. So once these imported goods coming from other countries that are suffering from inflation, yeah, once this product come to our country, this product will also become more expensive, which push our inflation also goes up, because we get the imported products, yeah, at a higher price than usual because they have an inflation. So this inflation will be transferred to our country, because now these imported products are selling at higher price. Imagine, for example, we are importing raw materials from China, and suddenly China have inflation. Yeah, so those products coming from China become more expensive because they are selling now at higher price. So these higher price products coming from China will push, yeah, our inflation, yeah, to goes up. Why? Because the imported raw material products become more expensive, so that our final products selling in the market will be also selling at higher price, will become more expensive. Yeah. So that's why we have the price feedback effect. Yeah, it is the process by which a domestic price increases in one country, yeah, can feedback on itself through export and import prices. An increase if the in the price level in one country can drive up prices in other country. This in turn further increases the price level in the first country. Yeah. So whenever we have, whenever we have an inflation, for example, in Indonesia, we have an inflation, we have a higher inflation, so that our products are more expensive. Yeah, this also will push the prices of the same product to other country increases. So for example, we have inflation and we are selling a palm oil to Europe, yeah, at higher price than usual. Thus, in that country, yeah, because of this one product higher price or more become more expensive, this will lead to an inflation in the euro because now they are buying, yeah, palm oil at a higher price, become more expensive, so that it will push the inflation rate to goes up in the Europe, so that when they sell the product to us, when they exported their product to us, to Indonesia, yeah, they will be selling them at higher price, because these are kind of the feedback effect, yeah, uh, due to the increase in price. Okay, so guys, we have a lot of types of exchange rate. The most famous one is float exchange rate, floating, yeah, floating exchange rate, and we have also the fixed exchange rate. Yeah, I explained before in the class examples, yeah, of countries that are using fixed exchange rate. For example, the United Kingdom, no, the Kingdom of Saudi Arabia, KSA, the United Arab Emirates, Bahrain, yeah. These are usually those countries located in the Gulf region. These are the countries that fix their currency to the US dollar. Yeah, for example, one US dollar equal 3.2 key real, yeah, real Saudi Arabia. Yeah, so they fix it. But in our country, the currency of our country are fluctuating. It is a floating currency. Yeah, it is a floating exchange rate currency. And it change minutes by minutes, yeah, second by second, hour by hour, yeah, and it is determined by the supply and demand of our currency. Yeah, so I will draw. So this is the supply and demand. Yeah, so this is the supply and demand model, and the y-axis here represent the exchange rate. Yeah, and the x-axis here represent the quantity. So if the price, yeah, if the exchange rate, yeah, of our local currency increase, if the price of our local currency increases, yeah, this will lower the demand and this will increase the supply. Yeah, so our currency become more expensive if we have an increase in demand and lower supply, but it will decrease. So the currency of our our currency will decrease in value or will be depreciated if we have a lower demand, uh, if we have a lower demand and higher supply. Yeah. And there's a market, we call this a foreign exchange market. So this market is the market that trade, yeah, they trade foreign currencies. nowadays it is not difficult to find those market. You can go to bank, you can go to exchange centers, yeah, to trade your currency, to exchange your currency. So the government, private citizens, banks, corporations, they usually exchange currency to foreign currency, local currency to foreign currency for daily use. Yeah. For example, there are several currency that are used, yeah, or traded daily in Indonesia. Real Saudia, because a lot of Indonesian are Muslims and they use Real Saudia to for Umrah and Hajj, yeah, for Islamic pilgrims. There is also US dollar, yeah, there's also yuan, because a lot of Chinese companies are also in Indonesia, say, so they do trade with China. Japanese yen also one of the common foreign exchange in Indonesia. Euro, yeah, because many of the Indonesians are, going to Europe uh, and 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 they trade also. So yeah, government, private citizens, banks, corporations, uh, they trade, yeah, and they use the foreign currency for the daily use. Okay, so this is a statement that those who demand pounds are holder of dollar seeking to exchange them for pounds. Yeah. And those who supply pounds are holder of pound seeking to exchange them for dollar. Yeah. So the model of supply and demand for the foreign exchange or for foreign currency are more specific, because we need to look, or we need to find those who, for example, demand for pound. Yeah, so we need to look for those who demand pound, yeah, which are the holder of dollar seeking to exchange them for a pound. Yeah, and those who supply pounds are holder of pound that are willing to exchange those currency to dollar, yeah, or for dollars. Okay. Yeah, so these are the buyers and sellers in the international exchange market for two currency, the US dollar and British pound. Yeah, so we have here the firm, household, governments, yeah, British, like I mean British companies. Yeah, we also have the citizens. Yeah, the US company that want to invest in Great Britain, and the speculators. Yeah, these speculators. So who are the speculators? Speculators are traders. Usually they buy foreign currency at cheap price and selling them at higher price. Yeah, so they try to make a profit margin. Yeah, by selling currencies, different currencies. Yeah, so they buy at the cheap price and then sell them at higher price. Okay, this is the look of the model of supply and demand for pound, for example. Yeah, so the y-axis here is the price of pound. Yeah, we see that the demand is downward sloping, and in our right side we have a supply curve. Yeah, we see that the supply is upward sloping. It has a positive slope, and the model are quite the same, except the trend in the curve. Yeah. So the exchange rate in the market, the exchange rate are in the market are the equilibrium price. Yes, this is where the supply and demand meets in the market. So the official exchange rate, yeah, is it's the price where the supply of such currency meets its demand. Yeah, it is the equilibrium rate that the supplier of such currency agree to trade with the demander of such currency. We have two terms that are widely used in economics. The first one is the appreciation of a currency. What does it mean, the appreciation? It is the rise in value of one currency relative to another. So this is where our currency, the local currency, becomes stronger in value. Yeah, it becomes more expensive to buy. It becomes, it becomes stronger in value, become more expensive. I will give you an example. For example, let's say that currently today, today, $1 equal to 14, Indonesian rupiah, 14,000 Indonesian rupiah. And after 3 days, and after 3 days, $1 is equal 13,000 rupiah. Yeah. In this case, the Indonesian rupiah is experiencing appreciation because it is now stronger in value. Now, before 3 days ago, for example, you need to have $14 in order to exchange it with $1. But now, after 3 days, you only need $13,000, to exchange $1 for the exchange of $1. It means that in this case, our currency, the Indonesian rupiah, is experiencing an appreciation, while the US dollar is experiencing a depreciation. Yeah. Okay. So because now you need less money, we need only 13,000 rupiah to get $1. Mean that our currency becomes stronger. Yeah. It become more expensive. Yeah. I mean, it becomes, the dollars become less expensive now. Yeah, because before we need to have 14 Indonesian rupiah to get $1, but now we only need 13,000 rupiah to get $1. Another example of this, for example, now let's say that today, $1 is equal to 14,000 Indonesian rupiah, and after 3 days, $1 is equal 15,000 Indonesian rupiah. In this case, the Indonesian rupiah depreciate in value, while the US dollar appreciate in value. Yeah. Now you need to have a 15,000 Indonesian rupiah to get $1. Yeah, while before, before 3 days, we only need 14,000 Indonesian rupiah to get $1. So in this case, Indonesian rupiah depreciate in value while the US dollar appreciate in value. Okay, so this is how we measure appreciation and depreciation. Okay, so this is the equilibrium exchange rate. Yeah, so the equilibrium or the official exchange rate that are used in the market to trade one currency to others, determined by the interaction of supply and demand in the market. If we have more demand in the market, if we have more demand in the market, then the price, yeah, then the price of pound dollar per price of pound, which is dollar per pound, will increase. For example, here too, yeah. But if we have less demand, yeah, if we have less demand, yeah, of course, the rate of equilibrium will also decrease. Let's say here become 1.7. Yeah. So the equilibrium exchange rate is determined by how much supply and demand in the market. It fluctuates by the movement or the change in the supply and in the demand in the forex market. So once the supply and demands meet each other, it intersect each other, yeah, it becomes the equilibrium exchange rate for that currency compared to others. Okay. All right. Okay. Now we will learn about what affects, yeah, the exchange rate, yeah, the factor that affect the exchange rate. But before that, we need to learn about a theory. Yeah. So this theory called law of one price. It says that if the cost of transportation are small, the price of the same good in different countries should be roughly the same. Yeah. So if there is no transportation cost, yeah, the price of the same good, for example, a bottle of mineral water, yeah, it should be the same, roughly should be the same between one country to another. Yeah. So this one, this is the law of one price. It says that if the cost of transportation are small, yeah, we have no transportation costs. Yeah, the price of the same good in this country and in other country would be roughly the same. Yeah, that's why when you go to other country, yeah, you'll find a similar, roughly similar prices for every products. Yeah, for the same product that are selling in different countries. Okay, and from this law of one price, we have a development theory called a purchasing power parity. Yeah, it says that it is a theory of international exchange holding that exchange rates are set so that the price of similar goods in different countries is the same. So purchasing power parity, yeah, it is a theory which try to hold that the exchange rate is a variable which set the price of similar goods in different countries to be roughly the same. Yeah. So this exchange rate actually will try to balance, yeah, the price of goods in different countries so that they become similar or the same. Yeah. So once, for example, we have, like goods with a cheaper price in country A, for example. Yeah. So the demand for this good will increase. Yeah, and this increase in demand will make an increase in demand for that currency, for countries A currency, so that the increase in currency, yeah, will try to adjust the price of that same good in different countries to have similar or to have roughly the same price. For example, I will give you a simple example. Yeah. For example, the price of water, one bottle of water, yeah, water in Indonesia, yeah, is cheaper compared to Malaysia. Yeah, Malaysia is more expensive, for example. This makes people want to buy water from Indonesia because they are cheaper. And the increase in demand for water in Indonesia will make the demand for Indonesian rupiah increase, right? So this will adjust the price. So the increase of the increase of Indonesian rupiah, the appreciation of Indonesian rupiah in value will then offset the benefit of the cheaper price that our product is selling. So before we have a cheaper product, yeah, and the demand increase, and at the same time it increases the demand for our Indonesian rupiah currency. And the increase in the demand of Indonesian rupiah will make our currency appreciate. It will make our currency become more expensive. And this increase in price, this increase in value, this appreciation will offset the benefit of cheap price for that product. So that's why, according to purchasing power parity, yeah, the exchange rate is a factor which adjusts the prices, yeah, of the same good in different countries to roughly be the same. Yeah. So this is we will explain to you in more detail in the next slides. Yeah. Here it says that a high rate of inflation in one country relative to another put pressure on the exchange rate between the two countries. So whenever we have an inflation in one country, it will affect the exchange rate between two countries. And there's a general tendency for the currency. Yeah, there is a tendency, yeah, for the currency of relatively high inflation countries to depreciate. Yeah. Why that happen? For example, Indonesia, yeah, Indonesia is selling water, but now we have inflation, so that our water become more expensive. Yeah. Once this happen, once we have more expensive product, nobody want to buy from us. Yeah. In this case, our export will decrease. Nobody want to buy from us, so that the demand for our currency, for the local currency, Indonesian rupiah currency, will also decrease because nobody want to buy our product. Our currency demands will decrease. Yeah. So the decrease in the demand for our currency will make our currency depreciate in value. Yeah. So whenever we have inflation, our product become more expensive compared to others, relatively to other product coming from abroad. Yeah, this will make, yeah, nobody wants to buy our products, so that the decrease in the demand will lead to the decrease in demand for our currency, and it will depreciate our rupiah, our local currency. Yeah. So here the law of one price and the purchasing power parity is a very important theory which explain, yeah, the reason, the reason or the rationality behind the movement of exchange rate. Okay. All right. So yeah, this is the example, yeah, of how the purchasing power parity and the law of one price apply. Yeah, let's try to read, yeah, the argument. The higher price level in the United States, yeah, the United States here is the local country, yeah, makes import relatively less expensive. Yeah, this is an opposite of what I just explained. So if we have, yeah, higher price, if we have inflation, yeah, this will make import relatively less expensive. Why? Because our local product are more expensive now. Because we have inflation, it will make our local product more expensive. This in turn, yeah, we will see that the foreign product become less expensive. Yeah. Yeah, we will see that the imported goods compared to our local goods become less expensive. So the US citizens, so our local citizens, are likely to increase their spending on imported goods. Or for example, this is in this case from Britain. So that's shifting the demand for pound to the right from D0 to D1. So the US citizen now, they see that the imported goods are less expensive compared to the local goods. Yeah, they want now to buy, the imported goods. Yeah, so that's it increases the demand. Yeah, for the local, for the pound, for the pound. Yeah, it increases the demand for pound. It will shift, the demand curve from D0 to D1. Okay, and at the same time, the British see the US goods getting more expensive. Yeah, because we have inflation, our local goods are more expensive now. Yeah, and the increase in the price, these more expensive goods, will make foreigners, the British, reduce their demand for export. So it will reduce their export, their demand. So this will supply, because we are not demanding the US dollar, we are not demanding the US dollar, so we will exchange them. So the supply of pound will shift to the left from S0 to S1. Yeah. So the result is an increase in the price of pound. The pound appreciates while the dollar is worthless or depreciates. So when our local product become more expensive, the British, they want less export. They are not willing to buy the local products, our local product, the US product, because they are more expensive. So once this happens, so this will increase the supply of pounds because nobody wants to buy our local goods. Nobody wants to buy the US goods. Nobody demand the US goods. So this will make the supply for pound in shift to the left. Yeah, from S0 to S1. And the reduced supply of pound, will then make the exchange rate appreciates. Now the British pound is becoming more expensive, while the US dollar become cheaper in value. It depreciates. Okay. Another example, what happened, for example, if we have the increase in interest rate. So we have an increase in interest rate and our increase is higher than those in British, for example. So the British citizen holding pound may be attracted into the US security markets because in the US, the increase in interest rate will attract those investors coming from Britain to invest in our security market because we are providing them with a higher interest rate. We are providing them with a higher return. So what will happen? The British citizens may be attracted to invest in the US market so that they will demand, they will demand US dollar. So the increase in the US dollar will make the demand for pound decreases. Yeah, remember, this is pound dollar. Yeah. So the increase in the US interest rate will make the British investor are more interested to invest in Britain, to invest in the US local security markets. So this will shift the demand of the US dollar increase and make the demand for pound decreases, because the British people, they are changing their money into dollar. They are exchanging their money into dollar. Yeah. So this why the supply of pound shift to the right, because we have an increase in the supply. Yeah, because because Britain investor, they are now exchanging their pounds, yeah, to US dollar. Yeah, and at the same time, while there is an increase in the interest rate in the US market, the US citizens are less likely to be interested in British securities because the interest rate at home is higher. So that the demand for the pound will shift to the left. Nobody want to exchange pound, so it will shift to the left. So the result that we will have a stronger dollar. So the dollar will appreciate while the British pound will depreciate in value. Okay, so there's a logic behind the increase in interest rate between and the currency between two countries. Yeah, we see which one is higher, which one is more interested to hold such currency, which one is more, more going to let go their currency and etc. And then we will have an appreciation and a depreciation in local and foreign currency. So in this case, we need to know, which currency are demanded more, which currency are less demanded, and then we can now once we have this idea, we can predict what will happen to one currency, whether it's going to appreciate and depreciate once we have this logic idea. All right. Okay. So the effect of exchange rate on the economy. So the level of import and export depends on the exchange rate as well as income, our income, and other factors. When events cause exchange rate to adjust, the level of import and export will change. Yeah, change in export and imports can in turn affect the level of real GDP and the price level. So once the change of our export and import, it will, of course, in turn affect our our national output, our national income, and it will also at the same time affect our price level. Further, the exchange rate themselves also adjust to change in the economy. So the exchange rate that we have is also depends on the economy of our country. Exchange rate effect on import, export, and real GDP, a depreciation of a country's currency. Yeah, if we have a depreciation less in value of our country's currency is likely to increase our GDP. Why? Because when we have a depreciation in our local currency, our local goods will become less expensive compared to the foreign goods. This will increase our exports. And our export increase, what will happen to our GDP? GDP will also increase. Yeah, so the increase in our export will lead to an increase in GDP. Yeah, because we have less. Yeah, our depreciation. Yeah, we have our currency is depreciated, right? We have a depreciation in our local currency. This will make our product less expensive compared to others. Yeah, so that's our export will increase, and at the same time, our GDP will also increase. Okay. All right. Okay, now we will learn about the G curve effect. So when we have a currency depreciation, a country's balance of trade may get worse before it gets better. Yeah, so our country's balance of trade will go decrease. Yeah, and after a little time, it will goes up. So this curve looks like a G letter. We call it G curve effect. And why this happened? Yeah, because when we have a depreciation in our currency, yeah, it will give negative effect on our imports. Because when we have a depreciation in our local currency, what will happen to our import? Our import become more expensive. Yeah, imagine you are a company, you're buying raw materials from foreigners, from other countries, and suddenly your currency depreciates. It will make this raw material, the price of the raw material, become more expensive, right? Become more expensive. So it will, yeah, give you a negative effect on the import. But once at the other at on the other side, uh, a depreciation of our local currency will boost our exports. Why? Because a depreciation in our local currency will make our product less expensive, will make our product cheaper compared to others, compared to those foreign or imported goods. So when we have a depreciation, yes, it will give a negative effect on our import, but after a little bit of time, this negative sides or this negative effect will be offset by the positive increase in our exports. Our product become less expensive compared to others. Yeah, so that our export will increase. People will buy our product because they are less expensive, and thus making our export increase. And at the same time, yeah, the lower local currency, yeah, low local currency or a depreciation in our local currency will boost our export and our economy. Okay, so yeah, we can say that a depreciation will benefit exports. Yeah, a depreciation will benefit exporters, and it will give bad effects on our imports because our imports become more expensive. We need more money to import products and goods and services. Yeah, while on the other side, yeah, our product become less expensive and it will boost our export. So in the policy making, for policy maker, they need to adjust the right, they need to put some efforts and trying to intervene the forex market so that they can adjust their foreign currency rate, so that it will not become too expensive for the important, and it will not become too cheaper, for our exporters. So we need to have the right balance for our local currency. That's why our local currency are floating. Yeah, it is a floating local currency, and it determined by the supply and demand forces in the market. So once we have more demand, our currency will appreciate, and once we have less demand, our currency will depreciate. And also we look at the supply side. Once our supply side become higher, our local currency will depreciate, and once become lower in supply, our currency will appreciate. So these forces, these demand and supply forces will then, determine our local currency rate. Okay. Yeah, so the depreciation of country's currency, yeah, tend to increase its price level. So how this happen? Uh, so when we have a depreciation in our local currency, yeah, it will, you know, increases our inflation, our price level. So a cheaper dollar is a good thing if the goal of the monetary expansion is to stimulate domestic economy. If consumers substitute US made good for imports, they will spend more on domestic product, so the multiplier actually increases. Yeah, so this is related to the monetary policy. Yeah, I don't know if we uh, I'm not I don't have any idea if you guys have learned about the monetary policy in more detail. Usually we explain monetary policy in one course, yeah, monetary economics. Yeah, so I'll just give you a basic idea to understand why when we have a depreciation in our countries, in our local currency, will lead to the increase in price level. Yeah, we can explain it by, if we have a depreciation in our local currency, our export will increase, and this will increase the price, the income level of the country. So the why the GDP will increase, and at the same time, yeah, our consumption will also increase. And if this consumption increase is not answered by the increase in more supply, yeah, by having more supply, so that the increase of consumption, yeah, becomes higher than the increase in demand on consumption will become higher than the supply on consumption. This will make the price level increase. Okay. Yeah, this is related to the monetary policy. Says that a cheap dollar is a good thing if the goal of the monetary expansion is to stimulate the domestic economy. So if consumers substitute US made goods for imports, yeah, they will spend more on domestic products, so the multiplier actually increase. Tight monetary policy works through a higher interest rate, which lower investment and consumption spending. Because when we have a higher interest rate, nobody want to spend and nobody want to invest on something. They'll just put their money to the bank. Yeah, they will not spend, they will not invest and put their money in the bank because they will get a higher interest rate. Yeah, so reducing the aggregate expenditure and output and lowering the price level. This also attract foreign buyers into US financial market, driving up the value of the dollar, which reduce the prices of imports and help fight inflations. Yeah. So these are the effect of expansionary monetary expansion monetary policy and a tight monetary policy. Yeah, so there's a different focus on each monetary policy, but tight monetary policy, by imposing a higher interest rate, will make the consumption and investment become low, because everybody will put their money in the bank, and at the same time it will attract foreign investor to invest in the country because it provides higher return in interest rate. Yeah, so that it makes our local currency appreciate in value and reduce the imports, because the import become more expensive, so it will reduce the import, and it will help fight inflations. All right. So this is in regard to the fiscal policy. Well, actually, there is a course, yeah, that focus on analyzing the fiscal policy. It is called public economy. Yeah, but I don't know if we have discussed about the fiscal policy or not. But this related to the government policy for, for controlling the income and the expenses made by the government. The openness of the economy and flexible exchange rate do not always work to the advantage of policymaker. So these are the things to consider. Without fully accommodating Fed, the three factors work to reduce the multiplier. Higher interest rate from the increase in money demand may crowd out private investment and consumption. Once we have a high interest rate, our investment will reduce, our consumption will reduce. Nobody will want to invest because they need to borrow the capital at higher interest rate. And usually when we have a higher interest rate, yeah, nobody will consume because they just put the money in the bank to receive a higher return of interest rate. Yeah, and some of the increase in income from the expansion will be spent on import. So the increase in income will be spent on foreign goods, on imports. So that's why it reduced the multiplier effect. And a higher interest rate may cause the dollar to appreciate, discouraging export and further appreciating import. Yeah. So once we have a high interest rate, it may cause the local currency to depreciate. Yeah. And this will, of course, discourage exports. Yeah, because our product become more expensive because we have high interest rate, high exchange rate. Yeah, appreciation in our local currency will make our export become more expensive. Yeah, so it will discourage the export and it will encourage import because once we have high a stronger currency, we will see that our local goods are more expensive compared to the foreign goods. The foreign goods become cheaper, and this will encourage imports. Yeah, so this will encourage imports. Yeah. So the monetary policy cannot play a role when a country has a fixed exchange rate unless it imposes capital control. So these things and factors and aspects that we have just discussed applies only in open economy. Once you apply it in closed economy, then we're going to have a different aspect and different things to consider. For example, when we are in a country with a fixed exchange rate, not a floating exchange rate, yeah, usually the monetary policy will not do well unless we can impose capital control. If we can, control on our capital, yeah. So this is how the differences between the floating exchange rate and the fixed exchange rate. Now, last but not least, yeah, this is the interdependent world economy. Nowadays the interdependency for one country to another is becoming more evident. Yeah, so we have the increasing interdependence between countries. Nobody can survive alone today, and the country need to do trade, need to exchange goods and services with other countries. They cannot survive alone. If they want to achieve growth, they need to export their product to other countries, and other countries need to buy their product, and etc. So the interdependency between countries are becoming more evident. The trend are increasing. Nowadays it is easy for us, to buy products from other countries in just using the application on our smartphones. Yeah, so yeah, the countries are becoming more interdependent each other. They cannot survive alone. If they want to achieve growth, then they have to trade and they need to be connected with others. I think this for today. Yeah, I think this is for today's topic. I hope that you can learn, yeah, some of the basic of international trade, balance of trade, and exchange rate. So our balance of trade depends strongly on the exchange rate. So if the exchange rate are favorable for us, yeah, we can conduct, activity that may get us some profits. Yeah, a depreciation in our local currency will boost our exports. Will and but at the same time, it will discourage our imports, and appreciation in our local currency will reduce our export, but it will boost our import. That's for today. Thank you, and I'll see you later. Yeah. I still have one video about the economic growth in developing country as the last topic to be covered before the finals. I will make video and I will upload it in YouTube and in my ETS classroom. Thank you, uh, and I'll see you later. Assalamualaikum warahmatullahi wabarakatuh.